In this short video, we're going to determine the initial cost basis of the asset being sold. But as a review, we know that the sales price, minusing out any selling expenses, is going to give us what's left over, called the amount realized, from which we subtract out the adjusted basis of the asset being sold, which is equal to that initial cost basis that we're trying to determine in this short video, minus the accumulated depreciation, to get that, again, book value or adjusted basis. And now we subtract out the adjusted basis from the amount realized to get a gain or a loss. Again, here's what we're focusing on in this video: the initial cost basis. So the simplest method is when the taxpayer buys the asset. That initial cost basis is going to be that cost that's being paid. And that's the most common way of determining that initial cost basis. Not common but possible are gifts, where the taxpayer receives the property as a gift. You gotta make sure in that case you know the value of the gift, the fair market value of the gift on the date the gift was made. And you compare that with the person who's giving the asset, that is called a donor, his or her cost basis, and determine whether the value is greater than or less than that donor's basis. Let me illustrate with an example when one or the other will apply. So here we have the donor, the person that's giving the property, and they have a cost basis, and it's being transferred, not sold, as a gift to our recipient called the donee. And on the date this donee receives that gift, we need to get a valuation for the asset's fair market value. Eventually, this donee will sell this asset to a third-party buyer. This is not another gift, where they're going to get a sales price, minusing out any selling expenses, and minusing out the adjusted basis of that asset, which is equal to the cost. Again, that's what this whole slideshow is about. Minusing out the accumulated depreciation to get that adjusted basis. And again, the leftover is the gain or loss. Now, the general rule is that the cost basis of this donor will carry over to the donee. So that's what you probably will see down here as the initial cost basis. But if, when you go through this gain and loss calculation and you end up with a loss, the tax laws don't want you to have a big loss. So if you go back to the date of the gift, if this fair market value is less than the cost, what you're going to do here for the initial cost is use this smaller fair market value, thus reducing the amount of the loss. Again, if you have a loss on this gifted property, you go back to the date of the gift and look at the value and compare that with the donor's original cost. And if that value is less than the cost, you're going to use that value as the initial cost here, reducing this loss, making the loss smaller. Otherwise, the initial cost here is going to be the initial cost that came from the donor. Okay, so that's a situation for a gift. Oh, and also, whatever holding period the donor had, maybe this donor held the property for years. And if you use the cost basis over here, that holding period will carry over to the donee's holding period, making the period even longer, probably turning it into what they call long term, and we'll see that in the next slideshow. Now, if you're using this fair market value as the cost basis when you sell, then the holding period for the donee starts right here. The clock starts right here, and none of the time the donor held the property counts to determine how long the donee held it. So maybe the gain or loss could be short term. Well, really the loss, probably. Okay, let's move on to the next situation, which is when the property is inherited. Here it says it's probably going to be used as the initial cost, the fair market value of the property on the date the person passed away. The person that's giving the property away that passed away is called not a descendant but decedent. And the property will be considered now in the hands of the person that received it. That person is called the beneficiary. That will be long-term property. Even though that beneficiary may have held it for just one day, automatically because you inherit it, it's considered to be long-term. Here it mentions that instead of using the date of death valuation, you can use another date 6 months after date of death. That's up to the person who runs the estate of the decedent. Again, let's kind of map this out. Here is the person that passed away called the decedent. Again, not descendant. And they have a cost basis to the property. But then the property is passed on to the beneficiary. And this is called an inheritance. I'm abbreviating here. So right here, when the beneficiary receives it on the date of death, we determine the value, the asset's fair market value. So when the beneficiary sells this property to a buyer, the cost basis, the initial cost basis, I won't show the gain and loss formula, will be this fair market value. And the beneficiary will have considered to be held this asset for long term, more than a year. So the gain or loss will be considered to be long-term gain or long-term loss. Okay. One more situation. Here, the taxpayer bought some property, but then converts it for business use, from personal use, just like using your car to commute to work or go shopping. But now you only are strictly using it for business. So we have a taxpayer, let's call this taxpayer, that has an initial cost basis, maybe just bought the car and is using the car, and now we converting it to business use versus over here personal use. It doesn't matter how long you've held it. What you got to do is now look at the value on the date of conversion, the fair market value. And if the cost basis is smaller than the fair market value, you use the cost basis in calculating depreciation. And you use that cost basis for the initial cost basis when eventually you sell this asset. Now, if the fair market value is less than the cost basis, you're going to use that fair market value to calculate depreciation from that point for the business. You're going to use that fair market value to determine the initial cost eventually when you sell this asset. Okay, so that's this is the second video for our chapter 3. The third video is a little more detailed, where we go into the different types, the different characteristics, the different categories of gain and losses, and how we combine them together and how they are taxed differently.